Sorry, Nikki. Rip it.
Reset it.
Okay. Good morning, everyone. Glad to see everyone survive the golf tournament yesterday. We'll make sure that Diego plays with a handicap next year. In all seriousness, it's great to see everyone in a formal setting, so thank you for being here. As you know, we are the research team for Norwell, but we consider ourselves an A team, and an A team deserves a name like Blanchard Capital. On our team, we have William, Jack, Diego, Bentley, Garrett, and our Nikki. I'll be kicking this off. We're excited to share our 3-year alternative investment strategy with you. As you know, our firm's AUM has doubled over the last decade, and with that, we think it's a good time to explore private real estate for our clients. So our objective today is just to show you the best fit that can do that. Before we get into the weeds, I want to frame the problem the way that we've been looking at it. Our clients are used to 60-40 portfolios, but they've been increasingly asking for higher income and steadier long-term performance. So we think that private real estate can meet those needs if we're selective. At the same time, onboarding these products is expensive. So we want to do as much of the analytical work up front to give you the best options. We started with 8 funds. Quickly, we got rid of 3 because they had poor governance policies. And then from there, we got rid of 2 more because they had consistent low performance. Those don't align with our fund strategy. So now we're left with 3, a private credit, a open-ended fund, and a closed-end fund. When looking at these funds, we looked at some key market drivers, like migration expanding multifamily and single-family rentals, the industrial boom continuing with onshoring, and the AI race leading to data center explosion. Finally, we have specialty. Senior housing and student housing continues to be on the rise. We think that these demographics are the tailwinds that we need. Later on today's high rate and low liquidity market, and we're actually having pricing dislocations we haven't seen in over a decade. This creates an intractable basis for us to come in at. So who are our clients? Well, they're high net worth individuals that have invested with us for over a decade, and they're not looking at banking anything out of the park. They just want to have consistent returns, meaningful tax efficiency, and monetary appreciation. So it's really not about picking the flashiest fund, it's about picking an opportunity that accomplishes this for them. And with that groundwork set, I'll hand it off to William to go over our pitch summary and our macro outlook.
Awesome, thanks Nikki. So before we dive into the details of our pitch, I'll just give a quick outline of what we ended up deciding on. First, we will invest in the debt fund, primarily due to liquidity reasons. And secondly, we'll invest in the open-ended equity fund, NREIT, primarily due to modest appreciation reasons. With that being said, now let's look at our macro outlook. The story of today's economy is one built by the fact that the economy is stabilizing rather than accelerating. Both inflation and the labor market are cooling, and we expect from our research team SOFR to drop sharply in 2025, but to grow slowly but steadily from 2026 to 2030. Now looking at specific sectors, we'll start with multifamily. From multifamily, we currently see a slight demand surplus, but expect by 2030 that to turn into a slight demand deficit. Vacancy will remain pretty stable, moving up by 0.4% over the next 5 years, but we expect projected rent growth to increase by 1.1%. Turning the page to industrial, this has also seen a lot of tailwinds over the last few years. While currently there's a slight demand deficit, we expect that to equal out and be at 0% and have an equal supply and demand part. We'll figure that out. Vacancy we expect to decrease by about 1.5% by 2030, and rent we expect to increase by about 2%. Now if we turn the page to specialty sectors, this is key to our ultimate pitch. These have seen some of the strongest secular tailwinds over the last few years, and we expect that to continue. Both senior housing and student housing are very strong due to, for senior housing, the increasing age population and a lack of supply, and for student housing, the increase in a record number of college applications, especially in the Sun Belt and the South. These, we expect, across the specialty spectrum, we expect to see consistent rate growth over the next few years. Now if we turn the page to the debt market, investors currently are seeking strong liquidity and low volatility, and that's exactly what debt offers. Currently, there are high refinancing needs, which benefits lenders, so that makes for a very healthy origination environment. Now, if we look at the core exposure across the 3 funds we were asked to evaluate, you can see starting from left to right, multifamily, industrial, office, and retail, and you can see where all the funds lie. So for NREIT, we see a broad diversification, which we thought was strong, and for the debt fund, we see a strong allocation to both industrial and multifamily, which we see a lot of tailwinds. Now I'll let Jack talk about the rest of the funds.
Thank you, William. We examined 3 different funds and imagined how they will fit into our potential portfolio. Starting with a credit fund, this is a core plus credit strategy targeting 8 to 9% returns. Will serve as the income engine of our portfolio. Moving on to Secret 3, this is a close-ended equity strategy that is looking to generate positive upside from appreciation. Lastly, with NREIT, this is our open-ended equity strategy that is looking to bring durable income and modest appreciation. Now let's take a look at the credit fund. We are confident about our sector positioning, with 87% of our book sitting in industrial and multifamily, 2 sectors with the strongest fundamentals and the clearest tailwinds. One major strength of the credit fund comes from its short duration. Our weighted average maturity is only 2.3 years, which protects us against long-term rate risk and allows us the flexibility to reprice loans quickly as markets move. Our floating rate loans generates us durable incomes, but we're protected on the downsides with rate floors. Okay, I'm blanking.
Nope, keep it going.
Okay.
You can wrap it up too. You can pass it to Diego, but keep it going.
Keep going. Okay. Moving on to our weaknesses. The weakness of the fund lies in our loan-to-value ratio. Most of our loans originated in 22-23, where valuations were near their peak. Since then, prices have dropped down 13%, putting some of our warehouse loans within margin call risk territory. This could potentially stress our cash positions in the future. But the credit fund is not without opportunities. We are skip. So where does this end up? Overall, we are constructively but cautiously positioned with strong cash generations now, opportunities to pivot into more attractive sectors in the future, and the liquidity to deal with any volatility in the market. Overall, this positions the credit fund as a great complement to the tax efficiencies and appreciation potentials of the equities fund, which Diego will now go into.
Thank you, Jack. Now let's zoom in on NREIT, which we see as our core anchor for NORA's private real estate sleeve. The fund is a large open-ended core equity fund. The goal is income plus moderate appreciation, and is expected, or they're targeting a return of 50 basis points against the benchmark. The scale is meaningful. Well, almost $11.2 billion of gross assets value across 86 investments, and now sits at a 30% loan to value. What really like about this fund and what stood out was their specialty allocation. 40% of their assets are located in specialty sectors such as manufacturing, student and senior housing, life sciences, single family rent, data centers, and self-storage. We know that those specialty sectors are cycle winners, and that's one of the reasons why this fund has performed well under current market corrections. But what's the most important thing to ask is, where does this fund fit our client? And that's where the SWOT comes in. For the strengths, this fund gives diversification, and the core holding on industrial and multifamily provides a benefit from long-term fundamentals. The portfolio is very well leased, and the balance sheet is conservative. 30% of the 30% of the fund is loan to value, 90% of the debt is fixed, and it has a 5-year weighted average loan maturity. On the weakness, well, it all comes to liquidity. It's discretionary. 5% of there's a redemption queue that is 5% of the net asset value, and it now sits at only 2% of cash to net asset value. On the opportunity, well, they're sitting on dry powder and a conservative balance sheet. What does this mean? Well, it allows them to buy into better pricing rather than being forced sellers. On the threats, we have 3 different threats that we identified. First, there's a pressure on the institutional core allocation. Second, there's a soft GDP and job growth expectation. And well, third, there's a mall exposure that all this creates downside risk that we know we need to underwrite, but most importantly, we need to communicate to our clients. The story is not, this is a perfect core end fund with no issues, but we'll use this next quadrant to sort of identify where this fund aligns to our platform. First of all, Nexus Manager has performed on the first and second quartile versus their ODC peers. The specialty allocation gives this core plus a twist that high net worth individuals really like. They would be buying 90% they would be buying the portfolio that is 90% leased and broadly diversified. And of course, well, the balance sheet. It's boring in the right way. Low leverage, fixed rate, and low refinance risk. In a nutshell, and looking to the client's expectations, we believe that this fund complies with with durable income, moderate appreciation that can beat the benchmark on a 3-year rolling basis. Now I'll hand it to Bentley to talk about the third fund.
12 minutes used.
Thanks, Diego. I now highlight Stoneway Capital's third REIT fund. It is a closed-end core plus focused fund targeting returns of 100 basis points over NPI. However, since its inception in 2013, it has exceeded this target in a embedded hurdle rate of 10%. Next one, please. Largely attributing to this success is its residential properties in the Sun Belt and industrial assets in high-performing markets such as Miami, Nashville, and Raleigh. It currently has 92% hold of core properties in its portfolio and is looking to utilize new cash to invest in value-add multifamily and pursue multifamily developments in select gateway markets. We believe that this timing will offer moderate appreciation of underlying assets while maintaining a steady but potentially low growth income stream. We currently have an opportunity to invest at 5% discount to NAV. This fund's capital structure is, however, a risk that we need to mention. Debt makes up 50% of its gross asset value, 40% of which is tied to a floating rate. Further, 40% of loans are maturing in the next 12 months, and there is significant near-term refinancing risk. Stoneway Capital intends to manage through this maturity using a combination of cash-neutral refinancing and/or dispositions to create and reinvest equity. The management of this becomes critical to the success of the fund, given the financing risk. Recapping, this fund offers immediate entry at a discount and a strategy for targeting premium returns. However, it comes with significantly greater debt management and minimal liquidity. Because of such, this fund presents an opportunity for clients looking for steady income with moderate risk, enhanced yields, and opportunistic real estate exposure, but must be able to support medium-term capital deployment. I'll now pass it to Garrett to recap our comparison.
Thank you, Bentley. Having covered the macro environment and detailed fund outlook, we now move into our final fund investment decision. As you can see from the scorecard, this serves as the foundation for our recommendation. We have plotted the 3 funds directly against the 5 critical objectives of our high net worth clients. As you can see, no one fund is a perfect fit. Therefore, we have recommended a dual fund strategy to best balance the needs of our clients. First, we recommend onboarding RCREF as our income engine. As this slide shows, it provides the current and stable income that our investors demand. Additionally, its 10% annual tender offer provides transparent and predictable liquidity. Second, we recommend onboarding NREIT as our return seeker. Though this slide is mislabeled, its core focus and sector diversification provide moderate appreciation as well as tax efficiencies that our investors seek. Furthermore, its conservative profile of 90% fixed rate debt and a 5-year weighted average maturity on outstanding loans provides protection against refinancing risk. This combination, RCREF for income and NREIT for growth, provide the best exposure to for our clients of the available options. However, we believe onboarding these funds is just the beginning. To secure our advantage in the current market, we must look ahead. And this brings us to our additional investment strategy. We propose that Nora Wealth Solutions leverage its platform to create a Nora opportunistic fund. This specialized fund would focus exclusively on investing in value-add and ground-up development of the most high-growth and resilient niche sectors of the residential market. Affordable, manufactured, and student housing provide current and stable income as well as superior tax efficiencies. Meanwhile, senior housing and build-to-rent allow us to capitalize on long-term demographic tailwinds, namely an aging population and the housing affordability crisis. Moreover, creating the Nora Opportunistic Fund will allow Nora to transform from a platform to a product innovator, allowing it to capture more AUM, higher margin fees, and a differentiated position within the market. In summary, our 3-year alternative investment strategy is clear. Onboard RCREF for best-in-class income, onboard NREIT for opportunistic growth, and begin development of the Nora Opportunistic Fund to secure our strategic advantage for the future. Thank you, and we'd be happy to answer any questions now.